1. What is the primary concern of business economics? A. Value judgments. B. Optimization of resources. C. Formulation of economic theory. D. National income determination. White heavy checkmark. Correct answer. B. Optimization of resources. Business economics focuses on the optimal allocation of scarce resources to achieve business objectives like profit maximization. 2. Which of the following is not an assumption of the law of demand? A. Price of the commodity remains constant. B. Consumer's income remains constant. C. Price of related goods remains constant. D. Taste and preference of consumers change. White heavy checkmark. Correct answer. D. Taste and preference of consumers change. The law of demand assumes that consumer preferences remain unchanged. If they change, demand may shift irrespective of price. 3. The concept of opportunity cost is best explained as A. Cost of producing one more unit. B. Cost of best alternative forgone. C. Cost incurred on fixed inputs. D. Cost of production minus profit. White heavy checkmark. Correct answer. B. Cost of best alternative forgone. Opportunity cost refers to the value of the next best alternative forgone when a choice is made. 4. In perfect competition, firms are A. Price makers. B. Price takers. C. Collusive. D. Oligopolists. White heavy checkmark. Correct answer. B. Price takers. In perfect competition, no individual firm has control over the market price. All firms accept the price determined by the market. 5. Demand curve under monopoly is A. Perfectly elastic. B. Downward sloping. C. Upward sloping. D. Perfectly inelastic. White heavy checkmark. Correct answer. B. Downward sloping. In a monopoly, the firm is the sole seller, so it must lower price to sell more, resulting in a downward sloping demand curve. 6. Which of the following is a feature of monopolistic competition? A. Homogeneous products. B. No selling cost. C. Product differentiation. D. Price rigidity. White heavy checkmark. Correct answer. C. Product differentiation. Firms in monopolistic competition differentiate their products through branding, quality, or features to attract consumers. 7. If price elasticity of demand is greater than 1, the demand is A. Perfectly elastic. B. Inelastic. C. Unitary elastic. D. Elastic. White heavy checkmark. Correct answer. D. Elastic. When elasticity greater than 1, a percentage change in price results in a larger percentage change in quantity demanded. 8. Marginal cost intersects average cost at A. Its lowest point. B. Its highest point. C. Zero output. D. Maximum profit point. White heavy checkmark. Correct answer. A. Its lowest point. Marginal cost intersects average cost when average cost is at its minimum. After that, average cost starts increasing. 9. Which of the following is not a factor of production? A. Capital. B. Land. C. Labor. D. Money. White heavy checkmark. Correct answer. D. Money. Money is not considered a factor of production. It is a medium of exchange, not directly involved in production. 10. Break-even point is the point where A. Total cost is equal to total revenue. B. Total cost greater than total revenue. C. Fixed cost is equal to variable cost. D. Profit is maximum. White heavy checkmark. Correct answer. A. Total cost is equal to total revenue. At the break-even point, the firm covers all costs but earns no profit or loss. Total revenue equals total cost. 11. What does the law of diminishing marginal utility state? A. Total utility increases at an increasing rate. B. Marginal utility increases with consumption. C. Marginal utility decreases with additional units consumed. D. Utility is constant for all units. White heavy checkmark. Correct answer, C. Marginal utility decreases with additional units consumed. As more units of a good are consumed, the additional satisfaction, marginal utility, derived from each successive unit declines. 12. Cross elasticity of demand is positive when goods are A. Substitutes, B. Complements, C. Inferior, D. Giffen goods. White heavy checkmark. Correct answer, A. Substitutes. When the price of one good rises and the demand for another also rises, they are substitutes, showing positive cross elasticity. 13. Which cost does not vary with output? A. Variable cost, B. Fixed cost, C. Total cost, D. Marginal cost. White heavy checkmark. Correct answer, B. Fixed cost. Fixed costs remain constant regardless of the level of output, like rent, insurance, or salaries of permanent staff. 14. In the short run, a firm can vary A. All inputs, B. Only fixed inputs, C. Only variable inputs, D. Capital only. White heavy checkmark. Correct answer, C. Only variable inputs. In the short run, fixed factors remain unchanged, only variable inputs can be adjusted to change output. 15. Which market has the highest number of buyers and sellers? A. Monopoly, B. Oligopoly, C. Perfect competition, D. Duopoly. White heavy checkmark. Correct answer, C. Perfect competition. Perfect competition involves a large number of buyers and sellers, all dealing in identical products. 16. Which one is not an economic activity? A. Teaching in school, B. Practicing as a doctor, C. Cooking at home, D. Running a shop. White heavy checkmark. Correct answer, C. Cooking at home. Cooking at home is a non-economic activity as it is done for self-consumption, not for monetary gain. 17. Price discrimination is possible only under A. Oligopoly, B. Monopolistic competition, C. Perfect competition, D. Monopoly. White heavy checkmark. Correct answer, D. Monopoly. A monopolist can charge different prices to different customers based on willingness to pay or market segment. 18. Law of supply shows a relationship between A. Price and demand, B. Price and supply, C. Income and demand, D. Price and utility. White heavy checkmark. Correct answer, B. Price and supply. The law of supply states that quantity supplied increases as price increases, and vice versa, ceteris paribus. 19. Which of the following measures responsiveness of demand to price change? A. Cross elasticity, B. Income elasticity, C. Price elasticity, D. Supply elasticity. White heavy checkmark. Correct answer, C. Price elasticity. Price elasticity of demand measures how much the quantity demanded changes in response to a price change. 20. The concept of consumer surplus was introduced by A. Alfred Marshall, B. Adam Smith, C. Lionel Robbins, D. Paul Samuelson. White heavy checkmark. Correct answer, A. Alfred Marshall. Consumer surplus is the difference between what a consumer is willing to pay and what they actually pay, coined by Alfred Marshall. 21. The long-run cost curves are A. U-shaped due to law of variable proportions, B. U-shaped due to economies and diseconomies of scale, C. L-shaped, D. Always upward sloping. White heavy checkmark. Correct answer, B. U-shaped due to economies and diseconomies of scale. In the long run, as scale increases, costs fall due to economies of scale and later rise due to diseconomies, forming a U-shape. 22. Which curve represents the marginal cost of production? A. Downward sloping, B. U-shaped, C. Upward sloping, D. Straight line. White heavy checkmark. Correct answer, B. U-shaped. Marginal cost initially falls due to increasing returns, then rises due to diminishing returns, forming a U-shape. 23. Which of the following best describes the production function? A. Relation between cost and output. B. Relation between input and output. C. Relation between price and demand. D. Relation between utility and demand. White heavy checkmark. Correct answer. B. Relation between input and output. A production function shows how output changes when inputs like labor and capital are varied. 24. In case of inferior goods, income effect is A. Positive. B. 0. C. Negative. D. Infinite. White heavy checkmark. Correct answer. C. Negative. For inferior goods, an increase in income leads to a decrease in demand, making income effect negative. 25. In economics, utility refers to A. Usefulness of a commodity. B. Profit from goods. C. Satisfaction from consumption. D. Demand generated by a product. White heavy checkmark. Correct answer. C. Satisfaction from consumption. Utility is the satisfaction or pleasure derived by consuming a product or service. 26. The kinked demand curve is associated with A. Monopoly. B. Monopolistic competition. C. Oligopoly. D. Perfect competition. White heavy checkmark. Correct answer. C. Oligopoly. In oligopoly, the kinked demand curve explains price rigidity due to different reactions to price increases and decreases. 27. Which cost concept is relevant for decision making? A. Sunk cost. B. Average cost. C. Marginal cost. D. Fixed cost. White heavy checkmark. Correct answer. C. Marginal cost. Marginal cost helps firms decide whether producing an additional unit is profitable. 28. When marginal product is negative, total product is A. Increasing. B. Constant. C. Decreasing. D. Maximum. White heavy checkmark. Correct answer. C. Decreasing. If marginal product becomes negative, adding more input actually reduces total output. 29. Isoquants are A. Curves showing equal revenue. B. Curves showing equal output. C. Curves showing equal cost. D. Curves showing equal demand. White heavy checkmark. Correct answer. B. Curves showing equal output. An isoquant shows all combinations of inputs that yield the same level of output. 30. The law of variable proportions is also known as A. Law of diminishing marginal utility. B. Law of returns to scale. C. Law of diminishing returns. D. Law of supply. White heavy checkmark. Correct answer. C. Law of diminishing returns. It explains how output changes when one input is varied while others are fixed, typically leading to diminishing returns. 31. Which of the following best defines opportunity cost? A. Cost of all available alternatives. B. Cost of the next best alternative foregone. C. Sunk cost incurred in the past. D. Total expenditure on resources. White heavy checkmark. Correct answer. B. Cost of the next best alternative foregone. Opportunity cost refers to the value of the next best alternative that is given up when a decision is made. 32. Demand is said to be inelastic when A. A small change in price causes a large change in quantity. B. Demand changes proportionately with price. C. Demand does not change much with price. D. Demand increases with income. White heavy checkmark. Correct answer. C. Demand does not change much with price. In inelastic demand, consumers do not significantly change their quantity demanded despite price changes. 33. In monopolistic competition, firms sell A. Identical products. B. Homogeneous products. C. Differentiated products. D. No product. White heavy checkmark. Correct answer. C. Differentiated products. Monopolistic competition is characterized by many sellers offering similar but not identical products with brand differences. 34. The break-even point is where A. Total cost greater than total revenue. B. Total revenue greater than total cost. C. Total revenue is equal to total cost. D. Marginal cost is equal to marginal revenue. White heavy checkmark. Correct answer, C. Total revenue is equal to total cost. At the break-even point, the firm makes no profit or loss, revenue just covers all costs. 35. If marginal revenue is less than marginal cost, the firm should A. Increase output. B. Reduce output. C. Shut down. D. Remain at the same output. White heavy checkmark. Correct answer, B. Reduce output. To maximize profits, output should only be increased while Mr. greater than or equal to MC. If M are lesser than MC, reduce output to avoid losses. 36. In perfect competition, price is determined by A. Government. B. Individual seller. C. Industry. D. Consumers alone. White heavy checkmark. Correct answer, C. Industry. In perfect competition, no single seller can influence price. It is set by market demand and supply in the industry. 37. Which of the following is a feature of monopoly? A. Large number of sellers. B. No barriers to entry. C. Product differentiation. D. Single seller. White heavy checkmark. Correct answer, D. Single seller. Monopoly exists when one firm controls the entire market for a product or service with no close substitutes. 38. The term equilibrium price means A. Price set by sellers. B. Price set by buyers. C. Price where demand is equal to supply. D. Price of luxury goods. White heavy checkmark. Correct answer, C. Price where demand is equal to supply. Equilibrium price is where the quantity demanded equals the quantity supplied, balancing the market. 39. A good with an upward sloping demand curve is called A. Giffen good. B. Inferior good. C. Luxury good. D. Complementary good. White heavy checkmark. Correct answer, A. Giffen good. Giffen goods defy the law of demand as their demand increases with price due to the income effect overpowering the substitution effect. 40. A horizontal demand curve indicates A. Perfectly inelastic demand. B. Unit elastic demand. C. Perfectly elastic demand. D. Inelastic demand. White heavy checkmark. Correct answer, C. Perfectly elastic demand. A perfectly elastic demand means consumers will only buy at one price, and any price increase will drop demand to zero. 41. In the long run, all costs are A. Fixed. B. Variable. C. Sunk. D. Marginal. White heavy checkmark. Correct answer, B. Variable. In the long run, firms can adjust all factors of production, hence all costs become variable. 42. An indifference curve shows A. Levels of income and savings. B. Levels of cost and output. C. Combinations of goods providing equal satisfaction. D. Combinations of price and quantity. White heavy checkmark. Correct answer, C. Combinations of goods providing equal satisfaction. An indifference curve represents different bundles of goods among which a consumer is indifferent. 43. A rational consumer always aims to A. Maximize cost. B. Maximize utility. C. Minimize output. D. Equalize income and expenditure. White heavy checkmark. Correct answer, B. Maximize utility. Consumers make purchasing decisions to achieve the highest possible satisfaction, utility, within their budget constraints. 44. In the law of demand, the relationship between price and quantity demanded is A. Positive. B. Inverse. C. Constant. D. No relation. White heavy checkmark. Correct answer, B. Inverse. As per the law of demand, when price increases, quantity demanded decreases and vice versa. 45. A market structure with a few sellers is called A. Monopoly, B. Oligopoly, C. Duopoly, D. Perfect competition. White heavy checkmark. Correct answer, B. Oligopoly. Oligopoly is a market dominated by a small number of large sellers, leading to strategic interdependence. 46. Which cost is irrecoverable and shouldn't affect future decisions? A. Marginal cost, B. Sunk cost, C. Average cost, D. Fixed cost. White heavy checkmark. Correct answer, B. Sunk cost. Sunk costs have already been incurred and cannot be recovered, hence they are irrelevant for future decisions. 47. In economics, the term normal profit refers to A. Maximum profit, B. Accounting profit, C. Zero economic profit, D. Marginal profit. White heavy checkmark. Correct answer, C. Zero economic profit. Normal profit is the minimum profit necessary to keep a firm in business and is included in total cost. 48. The demand curve facing a perfectly competitive firm is A. Downward sloping, B. Upward sloping, C. Horizontal, D. Vertical. White heavy checkmark. Correct answer, C. Horizontal. A perfectly competitive firm is a price taker and can sell any quantity at market price, resulting in a perfectly elastic, horizontal demand curve. 49. Price discrimination is not possible in A. Monopoly, B. Oligopoly, C. Perfect competition, D. Monopolistic competition. White heavy checkmark. Correct answer, C. Perfect competition. In perfect competition, identical products and perfect information prevent firms from charging different prices. 50. When the marginal cost curve lies below the average cost curve. A. Average cost is rising, B. Average cost is constant, C. Average cost is falling, D. Total cost is decreasing. White heavy checkmark. Correct answer, C. Average cost is falling. When marginal cost is less than average cost, it pulls the average cost down.